Welcome to Yahoo Finance Live. I'm Shauna Smith along with Dave Briggs. Let's get you up to speed on this afternoon's market action because we're still looking at losses. You can see the Dow off 258 points, although we are well off the lows of the day. That slight bump, if you want to call it that, coming after St. Louis Fed President James Bullard making some positive comments. At least that's how the market's looking at it when it comes to inflation. So we're looking at losses of only about 250 points. Trying to put a positive spin on today's declines. S&P off just about 0.8%. And you're looking at the Nasdaq 100, the worst performer of the three, off just over 1%. We've been closely following the action that we have been seeing in crude as of late, and crude getting a bit of a bounce this afternoon, up just below $74 a barrel. And taking a look at the sector action, you can see that reflected in the leadership that we are seeing today. The XLE up just over 2% on an intraday basis. Communication services, the only sector there holding on to gains. Worst performers are real estate and utilities. And real quick, taking a look at some of those energy names. Again, a lot of these names have been pretty beaten down, at least over the last couple of days. You're looking at Exxon today up just over 2%, as well as Chevron. A number of these names, Dave, in the green for this afternoon.
And an amazing collapse of the natural gas prices continues today as well. But it's
Wonderful.
Interesting how eager the markets are to hear anything dovish.
I know. At least that's been
consistent.
Hear it. I know. I didn't hear it either, but they're looking for anything that they can.
Tighter longer is all I hear.
Yeah, well, we got to take it.
Good stuff. Let's get you up to speed now on housing. Mortgage rates did not drop with the ball. They, in fact, went back up. The average 30-year fix now averaging 6.48% from 6.42. That's according to Freddie Mac. Well, that's down from their peak of north of 7%. Rates are still double what they were 1 year ago, said Freddie Mac's chief economist Sam Carter. Quote, mortgage application activity sunk to a quarter-century low this week as mortgage rates continue to weaken the housing market. Shauna?
And certainly, Dave, it's been interesting to follow the housing market, the weakness that we have been seeing there. And I think the question now is how low rates have to go in order to spur some of that activity. And that's a big question at this point.
I mean, I'm not an economist. We will talk to one later in the program about where these rates will go and need to go. But my sense is they'll probably settle in that 5.2 to 5.5 range. And I just don't think that's enough to unfreeze the market. Because if you paid somewhere in the threes, are you going to get off the sidelines to upgrade to a 5.2, 5.3? Yeah, I don't know, especially looking at the macro uncertainty in the economy. What do you think?
Yeah, certainly. I do agree with that. And I think that's going to drive where we are seeing the buying action. We know a lot of people have been migrating to areas that are more affordable. We're going to be talking to Zillow later on in the show, and they're saying affordability is going to be the theme for 2023, with people really focusing on where they can buy, where they can afford in order to get that house that so many first-time home buyers have not been able to afford over the last couple of years. All right, we want to get you up to speed on another big story of the day, and that's job cuts. Amazon, Vimeo, Stitch Fix, all announcing layoffs today. Amazon CEO Andy Jassy confirming plans to cut 18,000 employees across several teams, including HR and Amazon stores. Vimeo on that list too, announcing another round of layoffs, this time cutting 11% of its workers. Now, in an email to the team, the CEO noting, quote, further deterioration in economic conditions. It has certainly been a tough start to the year, especially in tech, where we already started to see some of those job losses last year. That has carried over to this year. And just in the first couple of days, more than 25,000 jobs have been shed from the tech sector alone. And that's not all, because taking a look at Stitch Fix, which is more so retail consumer facing, they're letting go about 20% of their workforce. Dave, their CEO, Elizabeth Spalding, is also going to be stepping down there. So an executive shakeup, companies really doing all they can in order to cut costs because of this potential recessionary environment that we are in, and people really changing how they're spending and how they're spending their time.
Interesting to see Amazon shares, as you showed, down at all, because investors cheer these layoffs, but down 1.5%. Usually they cheer layoffs, which tells you they're not nearly enough and not nearly a big enough picture for the Amazon story, which is largely an AWS story at this point. But I find that Stitch Fix probably the biggest news because it is non-tech related. We talk a lot about these tech layoffs. That is not going to do the trick. In terms of the Fed, we're not cheering layoffs, but the Fed certainly needs some. And you're talking about 10% of the GDP comes from the tech sector, but only about, 12 million roughly jobs in total in the tech sector. So if all of them were wiped out, it still wouldn't be what the Fed probably needs. Compass, the real estate giant, also laid off the third round of layoffs in the last year. Just about 450 layoffs, but they continue. They've gone from a $6 billion market cap to a $1 billion company. More bad news for the real estate sector. And the information reporting Twitter laid off 40 data scientists in terms of advertising.
Yeah, certainly a number of layoffs. We want to stick with that story and dive deeper into Amazon's plan to lay off 18,000 workers. For more on that, we want to bring in Nick Jones. He's JMP Securities Equity Research Analyst. Nick, it's great to see you. So let's talk about the impact here on Amazon, because yes, it's 18,000 jobs, but in the grand scheme of things, when you take into account Amazon has 1.5 million employees, it's a very small chunk. But how are you viewing these layoffs and what it could signal ahead?
Yeah, I mean, you're right. It's a very small chunk of their employment or their workforce. We view it as that they are starting to look at operating income. This is an area that investors are increasingly looking at. You want to see Amazon, give better guidance to these numbers as we progress through each quarter. So while, we don't think it's really going to move the needle materially, we like that they're focusing on this and they're making cuts, which should give investors some solace that they are paying attention. But as you mentioned earlier in the segment, the stock price isn't reacting, and clearly investors don't see this as, meaningful enough today.
Yeah, reacting, in fact, the opposite direction as we've become accustomed to, Nick. And it's good to see you. Are there more cuts coming to Amazon in terms of headcount or more cost cutting?
I mean, there could be, upper funnel trends on retail don't look great. Advertising generally follows retail, so the advertising segment will likely follow. And as enterprises are thinking about making layoffs, then they're also going to think about making cloud investments, or maybe just delaying them until they have more macro clarity. So overall, there could be more to come, but we like Amazon investing in future technology. We like them investing in growth. So for us, we don't think it has to happen. We still like the stock as it, from here today. But there could be more to come as upper funnel trends continue to deteriorate.
Nick, what's the level in terms of the scale of the cuts that you would start to get concerned? Because right now you still have an outperform rating on the stock, $140 price target. Like what you're saying, you're not too concerned about the news we're getting today. But when does that start potentially affecting your investment thesis?
I think for us, it'd be more about their ability to control operating income and kind of say 1Q guidance or how they're talking about next year. I didn't think they really needed to do more cuts. Clearly, the trends are indicating that they think they may need to preserve the operating income investors are looking for. If more cuts come, I think that's more likely to be viewed as a positive by investors. That wouldn't concern us more. That probably, if anything, gets the stock moving higher from here. If operating income really starts to become a problem, the lack of cuts would be more concerning in the coming quarters.
Amazon dropped about half its market cap just last year. What's the catalyst to get things back on track? Is it still largely an AWS story?
Yes, it is. It's definitely still an AWS story. I mean, we still want to see retail work. I think advertising is underappreciated, but heading into a recession, it's hard to like advertising going into kind of 2023. So really, we need to see AWS start reaccelerating. We need to see retail kind of, estimates need to start increasing on the retail segment. We kind of need to bottom out in terms of estimates and get more visibility on the macro situation. Is the Fed going to continue to increase rates, and by how much? I think once we get some visibility into kind of cost of capital, where rates are going, that's when investors can kind of pick their head up and start thinking about what back half of 23 and 24 starts to look like.
And Nick, I know you cover a number of consumer-facing names: eBay, Etsy, Poshmark, all on your list here. What do you think the 2023 has in store here in terms of the significance of the slowdown and what it means for so many consumer-facing names?
Yeah, it's going to be a tough setup. Saving rates are declining. They're very low today, so that means discretionary income is going to start decreasing. Within my coverage, we think Etsy's been one of the best performers with their kind of robust platform, a lot of tech enhancements to keep people coming back and going to different segments. But overall, it's really going to be tied to personal consumption expenditure. E-com will continue to gain share, but if discretionary spend starts to decrease, there's going to be overall less spend on retail. That will impact e-com, even though they're back to share gains. So it could be a tough first half, we think, for e-commerce, but we think it's looking better kind of in the back half as we get over easier comps. All that said, we think Etsy's positioned as kind of the best e-commerce marketplace right now.
And to follow back up on Amazon, Andy Jassy could not have been handed this baton at a worse time. They have shed more than $1 trillion since he took over. Is he, despite all that, making the right moves? Do investors have confidence?
We think so. I think it's just very much, the theme I keep hearing talking to investors is you can't fight the Fed, you can't fight macro. I think this is very much a macro Fed-driven market, and that's really compressing multiples. We were looking today, most of the multiples of the stocks we cover are well below their 5 or 10-year average, in many cases below one standard deviation below that, meaning multiples have compressed materially, close to what recessionary levels looked like during the great financial crisis. So I think this is very much a macro dynamic, more so than anything idiosyncratic to what Jassy is doing at the company.
Indeed. All right, Nick Jones, JMP Securities. Good to see you, man. Thank you. Just getting started here on Yahoo Finance Live. Coming up, stocks falling ahead of tomorrow's all-important jobs data. We'll break down the market action. And after 8 tries, Republicans still cannot agree on who their next speaker should be. Republican Senator Kevin Cramer will join us with his reaction. And could the end be coming for Bed Bath & Beyond? We look at what options the struggling retailer has left. Don't go away. All right, about 45 minutes left in the trading day. Let's get a check on markets quickly. Been a rough go, but somehow, some way, the markets liked what they apparently heard from some Fed speakers. We were down well over 400 points in the Dow. Still, though, down 300 points on the day, and the S&P dropping 1%. The Nasdaq again, the lead loser on the day, down well over 1%, 124 points. For more market reaction, we turn to Callie Cox, eToro USA investment analyst. Nice to see you, Callie. What do you make of not just today's market action, but how we've started this new and apparently rough trading year?
Well, it feels like more of the same, new year, same vibes almost. And I think we're getting that after the Bullard headlines and comments we saw today. Just a lot of grasping onto kind of macro indications here and there, a lot of trying to find some message within the economic data. And, frankly, I'm not surprised by that because not much has changed in the past few weeks. And I expect we'll see a good bit of volatility around tomorrow's jobs report.
So, Kelly, a good bit of volatility around tomorrow's jobs report. When we look out, though, for the rest of the quarter, maybe even into the second quarter, do you think we're going to retest those lows that we saw in 2022? And what to you is going to signal that we are near that bottom?
So I think it's going to depend on if we hit a recession or not. And I know that's kind of the consensus on Wall Street, that chances are we are heading for one, but there's also a chance we avoid it. I'm personally watching the job market and earnings to gauge if we're heading into a recession or not. Usually you see the job market flinch first, and we are seeing some signs of weakness in there. But we aren't seeing signs of weakness in the more leading traditional indicators like jobless claims, for example. So I'm watching those closely. Continuing claims are ticking up, which is a sign of worry. It shows that the people who have lost their jobs 6 months or more before that aren't able to find jobs in a tightening market. So I'm watching that. And then I'm watching earnings estimates, which have come down about 5% or so this year, but not enough to make me worried about a significant pullback in profits.
Do you think earnings estimates have further to fall, though?
Earnings over the past 10 recessions, S&P earnings have fallen an average of about 20% in the past 10 recessions. So I'd expect if we did hit a recession that we'd see an earnings pullback in at least the 10% range or so. Of course, history doesn't tell us everything about what's happening in the future, but it is a good guide on what to expect. So I would expect a little bit more pain on the corporate side.
Kelly, when it comes to Fed policy, how aggressive the Fed could potentially get. We had Kashkari out yesterday saying we need another full percentage point from the current levels. Do you think that's, I guess, a little bit too restrictive, or a risk that would be too restrictive?
It almost feels too restrictive right now. I mean, we're seeing the Fed's medicine working throughout the economy, and it's painful. It's painful even though it's a means to a good end. So, right now, rates are quite high, and we see the Fed letting its foot off the brake by slowing rate hikes. But we're warning customers, even if rates stay this high, even if the Fed tomorrow said that they're done raising rates and they want to keep rates high, that's still a tough operating environment for companies. And it still points investors toward a more value-driven environment. And it really highlights the importance of financial strength and cash flows. So to me, the level isn't as important as, the trend of, where the Fed is going. And it looks like the Fed could stay high for a while.
And you say it's portfolio purgatory. And what does that mean for investors, and what ought they do at this juncture?
Yeah, so I'm kind of hearkening back to my 10th grade English class there. Yeah, so we're considering 2023 as a year of portfolio purgatory, which isn't necessarily a bad thing, but it is a challenging environment. So we see it as two roads. We see, if we avoid a recession, the Fed could keep rates high, and that could keep a cap on markets as long as inflation stays high as well, because you're going to see a lot of what we've seen in the past. A lot of rallies, perhaps up to the 200-day moving average, and then the Fed essentially talking the markets down. At the same time, we could see a recession, which obviously we're not cheering for that, but it's definitely a possibility. And if we see that, we expect the bottoms to be taken out in the market, but the Fed taking action and possibly having to cut rates from there. Either way, we're telling customers it's a great year to prepare for what's next, because the present could be painful, but we all know that bull markets come after bear markets, and one could be coming sooner than we think. We could already be in one.
All right. I like that optimism there to end the segment. Callie Cox, always great to have you. Thanks so much for joining us here this afternoon. Coming up next, our next guest is saying that Bed Bath & Beyond's woes are the tip of the spear for retail bankruptcies. He'll tell us why next. A dire warning from Bed Bath & Beyond. Look at shares today, off just about 24%. That happening after the retailer saying that it may go bankrupt. Joining us now is Drew McManigal. He's Matco's CEO. He's worked with hundreds of companies either in or nearing bankruptcy. Drew, it's great to have you back on the program. We wanted to invite you back on the show today because we last spoke about 4 months ago, and you predicted the turnaround plan that Bed Bath & Beyond laid out at that time wasn't enough. I want to play a quick soundbite from what you had to say then and get your reaction.
You're coming to the party late. I'm not going to be one bit surprised if the Chapter 11 petitions haven't already been drafted or they're just waiting for signature. I'm also not convinced that this $500 million financing is going to be enough cash.
So you nailed it, Drew. The financing certainly was not enough. The cuts that they made did not seem to work out. So what happens now?
Well, I think it's inevitable that they file. I wouldn't be surprised to see them file as early as this weekend. There's no reason not to. I suspect they've been working on their debtor in possession financing. Their sales were off a third. I just don't think I think it's a fait accompli that they're filing. Quite frankly, I'm surprised. And at Matco Restructuring Group, we would have advised our client to file once we were in trouble. I mean, they were going to cut it. It was valiant that they tried to enact a turnaround plan, but as I said, they came late to it and it wasn't deep enough or far enough. As an example, they were going to close 21% of their stores, which just isn't enough. We would have gone in and looked at each and every store, and if it was losing money and if the sales weren't relevant, we would have shut it down. In turnarounds, you're just going to break a few eggs, and including the stock price. But much like an emergency room, if the patient dies, what difference does any of it make? And so the premise of a turnaround is to save the company so that it'll have another fight another day. And I don't think Bed Bath & Beyond is going to.
Guess I better run out and get that ironing board soon if you think this weekend is possible. If they'd have filed earlier, Drew, what might they have saved?
Well, a couple of things. First of all, the automatic stay of 362 of the bankruptcy code would have come into play immediately. That prevents vendors from creditors and others from initiating lawsuits, from continuing lawsuits, from trying to collect. It provides a process so that vendors know and that you're going to be an ongoing business. One of Bed Bath & Beyond's problems was that their vendor constituency has, as I said before, seen this movie. So they're worried about getting paid. So consequently, they tighten their credit terms, which means that Bed Bath & Beyond can't, fill its stores with inventory for sale. So the bankruptcy process allows you to remain in business within a process that gives creditors and others some comfort that, there's going to be a debtor in possession. It will be somewhat business as usual as you try to get your business plan turned around.
Drew, when it comes to potentially spinning off parts of its business, seeing what would maybe be attractive to some potential buyers out there, I know you're not an expert on Bed Bath & Beyond specifically, but you're very familiar with this type of process. Those conversations, how do you think they are playing out amongst executives right now?
Well, I think the question is, does a Bed Bath & Beyond brand have any value? And if so, how much? The Bye Bye Baby brand clearly has a value. Their drugstore, the Harmon drugstore chain has some value. So I think they're probably looking at trying to maximize value, which is what you do in a Chapter 11 such as this. And much like occurred in other retail bankruptcies, you try to maximize that value, see who would want to buy the entire business or parts of the business, and try to tee up those sales through a sale process within the Chapter 11.
You say this could be just the tip of the iceberg in terms of bankruptcies. Why do you say that? Who could be next?
Well, I think, listen, we've seen Toys R Us, we've seen Sears, we've seen Penny, JCPenney's, which has been in a turnaround for some time. There's a recession coming regardless of what, the pundits may say or one side or the other. Consumer confidence, I think, is waning. And if you look at the recent information that came out today, holiday online sales were higher than ever. I've got to tell you, I put out so many boxes from Amazon and other deliveries over Christmas. I'm surprised my community isn't going to surge charge me for picking them all up. But there was very little shopping. So I think that that's going to continue, and that's going to affect big box retailers and some of the smaller chains that are still going to continue to have problems. And that's where, when you're doing a turnaround or workout, if we get called, then you're going to have to very, very quickly make a determination of what's working, what's not, and where, and how you can conserve cash, because cash is the lifeblood of these businesses. If you run out of cash, you're out of business, and that's one of the things that has affected Bed Bath & Beyond.
Well, let's hope some others do it right and we don't lose more ahead in 23. Drew McManigal, good to see you. Thank you. New York's Attorney General is suing the founder of the now bankrupt crypto platform Celsius Network. The AG's office claims Alex Mashinsky engaged in a, quote, scheme to defraud hundreds of thousands of investors by using false and misleading representations to induce them to deposit billions of dollars in digital assets with Celsius Network. The complaint alleges Mashinsky promised customers Celsius was a safe alternative to banks, while concealing the platform was engaging in risky investment strategies. Celsius filed for bankruptcy in July of 2022. Coming up, the House is still voting, trying to figure out who its next speaker will be. U.S. Senator Kevin Cramer weighs in on the madness after the break. Three days, 8 rounds of voting, and still no Speaker of the House. A group of 20 far-right Republicans refusing to support Kevin McCarthy, who instead of holding the gavel is left holding the bag, as the expression goes. Senator Kevin Cramer of North Dakota joining us now as a 9th vote is underway in the House. Senator, it's great to see you, sir. This is quite the debacle. Your reaction on Twitter struck a chord with a lot of Republicans and frankly, independents and Democrats alike.
Yeah.
Tell us what your reaction was and why you're so infuriated with what you're seeing.
Well, I'm very frustrated, and frankly, I'm embarrassed for some people who don't seem to be, they maybe seem too arrogant to be embarrassed for themselves. One of the things I've noticed, and I've spent 6 years in the House, all 6 of them in the majority, I watched as some members, a small group, the Freedom Caucus at the time, drove John Boehner out of the speakership. I think in some respects, the same happened to Paul Ryan, who chose not to seek re-election. And I think what's happening is a number of these people have never served in the majority. They've only been in the minority. And we even heard a few of them the other day, confirmed by several news sources, say that they're comfortable having a Democratic Speaker of the House because they could fight him. Well, the difference between the minority and the majority oftentimes is the difference between fighting and governing. They demonstrate a willingness to fight, and I get that. I get that people want a fight. But at the end of the day, the responsibility and the burden on the majority, and frankly, the opportunity for the majority, is to govern. So I am frustrated that a small group are holding hostage at the mass, the 200. When 20, I think my tweet was something to the effect, when 20 people govern 200 against their will, that's not conservatism. That's chaos. And so we really do need to get Kevin in the speaker's chair and start governing because the country needs it.
Senator, it's Shauna here. It's good to see you. Are you optimistic that McCarthy is going to be able to get the votes he needs? And then going forward, if he does get those votes, do you think he's going to be able to unite the GOP within the House, given the fact that there are so many holdouts?
So your second question is the problematic question, I think. You can get to a point where you've given so much up to be a leader that you no longer lead. Mm-hmm. You no longer have the tools that you need as the speaker. Remember, the speaker of the entire House. Just a few weeks ago, I was one of the Republicans in the Senate that voted against the omnibus, or awful bus, as I like to call it, voted for the 6-week CR in hopes that Kevin McCarthy and the House Republicans could return us to regular order and bring a more conservative approach to the appropriations process. The concern that several people did have that voted for the omnibus, and even some of us that didn't, is that they wouldn't be able to govern. And sure enough, here we are. The easiest thing they're going to have to do this year, frankly, is pick a speaker. It doesn't get easier after that. When you talk about a debt ceiling increase coming up, keeping the government funded and open, providing enough resources for national defense, it's a big job, this governing thing. And I think they need to be about the business of doing that.
Former President Trump weighed in, urging the House to vote for Kevin McCarthy. It moved 0 votes. Yeah. A lot blame him for what happened in the Senate, the fact that Democrats did in fact hold. What does that say about his influence as we move forward?
Well, I think what it says, one of the things it says about his influence is that the group of people that he's talking to, who would, I think for the most part, you would align with Donald Trump, aren't really interested in listening to leaders. I thought Donald Trump's plea has been very statesmanlike, frankly. I think it's been solid. I think he makes a great point about stop playing games. This is serious business. Let's move on with governing with the Trump agenda, the America First agenda. But remember, this is not a philosophical fight. When you have Lauren Boebert and Marjorie Taylor Greene, who most people think are attached at the hip philosophically, on the opposite side of this issue, there's something else at play. What concerns me, guys, is that some people have confused their jobs with your jobs, or perhaps more accurately with Tucker Carlson or Laura Ingraham or Mark Levin, and they got to get over that. Mark Levin and Laura Ingraham aren't confused about the difference between their jobs, and they can't be either. So, am I optimistic about Kevin getting there? I'm optimistic about him getting there, but only if his people stand firm, if they're willing to go to 133 ballots or whatever the historical marker is, just like their opponents are, perhaps we get there. But what's more likely to happen is as there's some deterioration and some fatigue, Republicans, reasonable adult Republicans in the House, are going to have to look to Democrats. And that is not what I would think those 20 Republicans want to have happen. They've made their point. They've stood their ground. They've demonstrated their fight. Now they need to demonstrate their ability to govern.
Well, Senator, given the dysfunction that we currently are seeing within Congress right now, let's talk about some issues that you see both sides of the aisle able to agree on. We've talked at length about crypto regulation in recent weeks. We talked about a crackdown when it comes to big tech. What are some of the issues that you see both sides being able to come to an agreement on?
Yeah, so in the Senate, the first thing I think we have to do is, and this is where the House can be very helpful, by the way, is get back to regular order. Once the House has a speaker, and they will, it will be a Republican, I'm confident. I think it's most likely Kevin McCarthy. But once that happens, then we have to start the process of governing in regular order. While I'm more than happy in the Senate to work with my Democratic friends, to get the ball rolling on a few issues such as immigration reform. I think a divided government, by the way, presents some opportunities here. Immigration reform, the border, dealing with the mandatory side of our ledger. Social Security, Medicare are facing insolvency in just a matter of years and not decades anymore. And these are challenges I think that both sides recognize, and I think they present opportunities. Permitting reform for infrastructure, whether it's energy infrastructure, whether it's green energy or fossil energy, transportation infrastructure, building more with less. All of these things help attack the overall economic challenge, while at the same time, I think presenting some opportunities to work across the aisle. But the first thing we have to do is get the House in order and start with some regular order so that we can have a committee structure and committee process that actually works.
Both parties have struggled with that immigration issue for 30 plus years. Shauna mentioned the possibility of crypto regulation, which is, of course, a hot topic because of FTX. Is there some agreement on that?
I think there can be. I'm on the banking committee. Every time I think I know what there is to know about cryptocurrency, I find out I don't, because something else happens. So getting our heads wrapped around it, I think, has been a challenge. I actually think, like a lot of things, the FTX situation sort of demonstrates some of the shortcomings, some of the challenges, and perhaps some of the opportunities for reasonable regulatory oversight, particularly as it relates to an exchange versus the currency itself or some of the other things. One of the problems we often have is that regulations are often an overreaction to a problem as opposed to just a correcting. So I want to be careful of that. But I do sense that there's certainly some bipartisan work. There's already been some work, on the Senate Banking Committee between Senator Gillibrand, a Democrat, of course, and Cynthia Lummis, Senator Lummis from Wyoming, a Republican who care about this issue. And we can approach it from different sides and meet someplace in the middle, which generally ends up with some pretty good policy.
All right, Senator. Well, I don't play party favorites, but when it comes to the FCS National Championship, I used to live in South Dakota. I know that's on Sunday. You can go ahead and give it a go, Bison, because that's a wonderful zip-up you're wearing there.
Well, let me just tell you that the Bison are playing for their 10th time in the last 12 years in the championship game, and I suspect they've never faced a challenge quite as big as this one against the Jackrabbits of South Dakota State. So good for the Dakotas. We'll see which half has the best team, but I'm saying go Bison, of course.
All right. Well, good luck to your Bison. Senator, great to have you here. Thanks so much for joining us.
My pleasure. Thank you for the opportunity.
All right, well, coming up next, the FTX contagion hits crypto bank Silvergate. Find out what has investors spooked and shares free falling today. You look at the stock off 42%. We'll be right back. It's time for our triple play. 3 stocks that we're watching in the final 20 minutes of trading. We have Walgreens, Silvergate Capital, and Constellation Brands. Josh Shaver on set with us here to break down today's big movers. Let's start with Walgreens because it is the worst performer in the Dow today, on track for its biggest daily decline that we've seen in this stock in just about 6 months. You're looking at shares off about 6% right now. The company reported quarterly results that beat the street's estimates. They raised their yearly sales forecast, but investors are taking issue with the fact that it held its profit guidance in place. There's a number of headwinds facing the company, including a settlement related to the opioid crisis that'll cost it about $6.5 billion overall. Waning demand for COVID testing and vaccines, something that we've heard from some of its competitors out there, has certainly been another challenge to Walgreens. Now, Walgreens has declined 6 of the past 7 trading sessions. Josh, it's off more than 30% in the past year. A number of challenges ahead. We will see, though, the different moves that Walgreens is making, more specifically investing in their healthcare sector there, in terms of whether or not that's going to help maybe boost revenue down the line.
And perhaps in a position to maybe do some cost cutting, right? And one area that they highlighted that they're going to be cost cutting was in the theft area and security. So we've heard a lot about theft at CVS, Walgreens, those different chains. And they actually said, Dave, this sort of stuck out to me, the CFO saying, maybe we cried a little too much last year about theft, and they said that the security has been cut back. They're not investing as much in private security at the stores because the theft is now down from 3.5% of sales last year, stabilizing at 2.5%, and they feel comfortable with that amount now.
I'm surprised, though. Retail shrinkage, as some call it, is up through the roof. So it's down for them, which tells you what they're doing is actually working, and yet they're going to cut back on
But they said the police
security.
officers have been more effective. So they have police officers too. So it's about which way they're going about
Somehow
it.
they're measuring the impact of police officers.
Depending on
versus
who's outside the store, I guess, is what's
Sure.
making the difference. Certainly interesting to follow.
Interesting.
My play today is Silvergate Capital. Shares sliding more than 40% as the bank revealed the FTX collapse has caused a significant blow to its business in an early release of quarterly results today. Silvergate, which provided services to FTX, saw clients withdraw $8.1 billion in the fourth quarter, dwindling what was once $11.9 billion in deposits down to $3.8 billion. Now, Silvergate liquidated that to handle the influx in withdrawals, causing a $718 million loss. The company also announcing today it's cutting back its workforce, reducing headcount by 40% to, quote, account for the economic realities facing the business and industry today. Now, shares of Silvergate have been under pressure over the last few months as the bank has been named in class action lawsuits. One of those out in California claims Silvergate is liable for furthering FTX's investment fraud and taking firsthand participation in commingling funds, Dave. And really where this sort of stands out to me too is Silvergate was a bank that decided to get involved in crypto, right? We know plenty of banks that have opted to not get involved in crypto. Yeah. And we're seeing where that can maybe go bad. Silvergate saw crypto as a big growth strategy for itself as a bank, and it did not end up helping them out here. And now they have this big overhang because they have a business that some analysts still like from a traditional banking standpoint, but crypto kind of becoming a big overhang for them now.
Yeah, they were at 90% of their assets currently, or when this all started in terms of digital. My question to you is it cold storage for people? Where do they put it now?
Yeah, I think that's the answer right? We seem to be getting from a lot of the guests. It's the old school, or the new school mattress, I guess we should say, right?
That is scary. An interesting note, Josh, from Wells Fargo, the worst case scenario seems to have come to pass. They also add, we think there has been way too much optimism regarding near-term crypto value improvement, so don't hold your breath about a quick turnaround for the price of Bitcoin or Ether or any others. My play is Constellation Brands, STZ, shares plummeting today after the spirits maker of Casa Noble tequila, as well as beers like Pacifico and Modelo, reported a lower third quarter profit. Constellation said its Q3 net income also fell slightly to $467.7 million from $470.8 million. Now, excluding losses from its stake in the cannabis company Canopy Growth, which is really key here, Constellation earned $3.01 per share. But however, you see the shares have plummeted more than 9% today. It has been a very rough go for them. Cost they didn't see that coming. The CEO said there were some issues out in California as well. A difficult Q3 report.
Yeah, pricing a huge issue for them. They're saying that they're going to be raising their prices on some products here going forward. You mentioned the weather out in California. That was mentioned by the CEO as well. It's interesting here, though, when you take a look at the drop that we're seeing today, some analysts, though, viewing this as a buying opportunity. David, RBC was out with a note today saying that now could be a good entry point because they do see the environment improving for Constellation, at least during January and February. So take advantage of the dip now is what they're saying, that 9% drop that we're looking at in stocks. It's hard, though, when you take into account the fact that it is a consumer-facing brand running up against a slowing economy. You think that that would have a longer-term impact on a name like that.
Distribution to retailers was down to 5.7% in the quarter, down from 8 to 9% in past quarters. People are buying less beer, or at least the retailers are buying less beer because they're not selling it as much. Is that really going to turn in the next quarter or two as we wonder where consumers
They feel
are spending?
they have a higher end beer consumer with,
Sure.
with Modelo and Pacifico.
We will see. We'll see whether or not RBC is right, saying now is an opportunity to buy. All right, well, coming up next, EV excitement is setting sail. The CEO of Brunswick joining us to tell us how his company's new boat brand will allow people to get on the water more sustainably. We'll be right back. Delta announcing today that it's going to offer free Wi-Fi on all of its flights. CEO Ed Bastian telling CES attendees that Delta is partnering with T-Mobile on this service. The free Wi-Fi will be available to everyone. It doesn't matter whether you're in first class or if you're in economy. However, you do need to have Delta Sky Miles account to use it. Now, Delta is saying that the service is going to be available on most domestic mainline aircraft by February 1st, with full availability on international and regional aircraft by the end of 2024. Delta shares today moving to the upside on the news, up just about 2%.
All right, it's day 2 of the Consumer Electronics Show in Las Vegas, and our coverage continues now with Praz Subramanian joining us with some very cool sustainable news from the boating world. Hey, Praz.
Hey, Dave. Thanks so much. Brunswick, the world's largest recreational marine company behind brands like Boston Whaler, Sea Ray, and Mercury, is making waves at CES this year. Joining me now to discuss is CEO Dave Folks, live from Las Vegas. So, Dave, let's talk about what you have the floor there. Unveiling a new line of electric outboard motors. What can you tell us about them?
Yeah, we are very famous for the Mercury Marine brand of outboard engines, conventional outboard engines. And we've announced that Mercury is extending its outboard product line into the electric range. So these are relatively smaller horsepower engines, but there'll be a full line that will gradually get more and more powerful as the technology evolves. So they're really meant for somewhat smaller boats, but they're a beautiful outboard, not just an outboard, a whole set of controls, digital gauges, propellers, even a connected app. And we also launched a new boat line called Veer, specifically to support that electrification push.
Yeah, so speaking of those small boats, the Veer boats there, the new brand there, that looking to leverage the electric propulsion of those Avator motors. So what's the story behind that new brand? How did you guys sort of come up with it?
Well, really, we were trying to think of a way to present electrification in a unique way that was relevant for the next generation of boater, if you like. So I think, electrification brings with it a set of expectations that are developed in automotive and other areas. And we wanted to make sure that as we presented our electric solutions, they were presented in a very contemporary way. And the vessel is a great vessel. It's like a kind of multi-tool, like a Swiss Army knife vessel. You can use it for fishing, for diving, for all kinds of excursions, for adventuring. So we thought it was a very contemporary way and a contemporary kind of showcase for that new Avator electric outboard brand.
So you mentioned your customers, but both existing and new. Are they sort of asking for electrification in the boating and marine activities world?
I think what they're seeing electrification emerge in other areas, and so they're interested in how it's going to develop and evolve in marine. There are very specific marine challenges around electrification. Boats tend to take more power. They're very weight sensitive. And they don't have brakes like cars. So electrifying a boat is somewhat more challenging. And I know our boats is obviously, if you think about range anxiety in a car, and then you think about range anxiety on the water, obviously it's higher. So we need to demonstrate to those boaters that this is a very high quality, safe, usable, functional solution for them. But in general, boaters are pretty tech forward. They respond well to technology. And I think that they will certainly accept this new line of Mercury electric outboards, certainly based on the incredible reputation for quality and functionality that Mercury has behind it.
So speaking of new tech, I believe at CES you guys have an autonomous sort of cockpit there for teaching people how to use autonomous boating in some sense, and it's using VR. So talk to me about that and what's been the reaction so far?
It's been an incredible reaction. Exactly right. We have a display sets up with what we call Future Helm, which is an idea of what a helm might look like maybe in 5 years' time. And around it, there's a 140-degree display. Think about an IMAX type display that's very immersive. So you can operate the boat just as you would a real boat, and then you can simulate autonomous functionality like auto docking or obstacle avoidance, those kinds of things where autonomy or augmented solutions can really help a boater. But this is, of course, not just about simulation. We have real boats in development that have those features, are able to self-dock, are able to recognize objects on the water, are able to avoid them, can assist a boater or captain in those more stressful boating situations. But of course, we can't demonstrate that physically at CES. So this demonstrator has been a wonderful way to illustrate the possibilities to the CES audience.
So Dave, we'll have to wait to see these electric boats and also autonomous boating tech, maybe on the West Side Highway by Chelsea Piers someday soon. So Dave, folks of Brunswick, thank you so much for joining us.
Thank you so much for having me.
All right, back over to you guys.
All right, Praz, cool stuff there. That was Brunswick CEO with us. Coming up, we're counting down to the closing bell on Wall Street. Stick with us here on Yahoo Finance Live. See how those markets finish the trading day. All right, just a couple of minutes away from the closing bell. A lot of red on the board. Let's bring in Inez Ferre to break down the market action. Hi, Inez.
Hi, Dave. And the markets are going to close lower ahead of that jobs report tomorrow. The Dow down 330 points. It was down more than 400 points earlier this morning. The Nasdaq going to close near the lows of the session, down 1.4%, and the S&P 500 down more than 1%. Over on the sectors, we're seeing real estate, utilities, technology that has been leading to the downside throughout the day. Energy, the winner for the day, as well as communications services. Here's the closing bell for today, Thursday, January 5th.
All right, that does it for today's trading day. Dow ending off the lows, like Inez was just saying, closing off just about 340 points as we shake out the final trades of the day. The S&P off just over 1%. The Nasdaq off just about 1.5%. Let's talk about it with Anthony Sakara. We have Providence Financial and Insurance Services President, and also David Waddell and Associate CEO and Chief Investment Strategist. Great to see you both. David, let me start with you. In terms of the action that we've seen this year, coming off a very weak 2022, it hasn't been shaping up much better so far this year. What do you make of the action that we're seeing?
You know, actually, so far in 2023, what's worked this year is what worked last year. International markets have actually held up better, which they did last year. Values held up better. The financials did fine today, relatively. It just continues to be valuation compression. I mean, the challenge for this year is that nobody really knows, right? So I think the high end of the S&P targets is like 5,000. The low end is 3,000. So on any given day, the market's just waiting for a report from the Fed on earnings, and we're only going to, average hourly earnings on wages, and we're only going to get 12 of those this year. So there are going to be 12 data points this year that matter, and in between those, we'll just fluctuate back and forth.
Anthony, David says nobody knows. We trust in you to know. Are we going to continue this type of action? What do you see as a potential low for the S&P?
Well, for sure, David is right. No one knows for sure. I think the S&P could go down another 20 or 30% from here, which then puts us in that 3,000 range that we're talking about as well, that David has suggested. So I don't think there's anything unrealistic about that at all. It's all going to boil down to what the Federal Reserve does, and the Federal Reserve is all going to boil down to what interest rates, what inflation does, and inflation is going to boil down what happens to the unemployment number. It's the unemployment number right now that is keeping everything at bay. It's keeping inflation high. It's keeping the Federal Reserve on a very aggressive path. They've told us that they're going to keep raising rates. The challenge, though, is that when you have your foot on the gas, and you're coming up to traffic and you see some brake lights start to get on, you want to take your foot off the gas. You want to act with a little bit of caution. You want to approach a traffic cautiously, slowly, looking around, and you don't want to keep your foot on the gas because you're going to crash into the cars in front of you if you're not cautious. And they kept their foot off the gas too long at the beginning of the inflation cycle, and they didn't catch up to speed. All the cars were passing them, and now the cars are slowing down. And as they're approaching, they're keeping their foot on the gas. I'm just afraid that they're going to drive this economy into a recession that's going to be much deeper, much longer than it needs to be. They need to ease off the gas and just look at what's happening with inflation. Inflation has already started to slow down, but they need to take a look at that, take a pause, to coast a little bit before continuing to press down on that gas pedal.
David, how aggressive do you expect the Fed to be this year? And talking about Anthony's point, easing up a bit, when exactly do you expect that to actually happen?
I mean, we got a big data point today that people glossed over, which was Bullard sort of softening a little bit, and he's been an ultra hawk. What freaks out the Fed is inflation, right? We topped out at the CPI at 9%. Now we're at 7%. But during that period of time, over the last 6 months, wage inflation's gone nowhere. So to get the average hourly earnings percentage down from 5% where it is today to 3% or less where they're comfortable, is going to require 2 million people to lose their jobs, right? So the sooner, let me say it this way. Last year, it was the Fed versus the markets, right? They needed valuations to come down. They wanted equities to go down. They wanted bonds to go down. They wanted housing prices to go down. They got that. This year, it's going to be the Fed versus employers. And what the Fed has told employers is we're not going to stop until you fire 2 million people. So it's great that Amazon laid off 18,000 for their purposes, but we got a long way to go. So there's going to be a whole lot more reductions in payrolls to try and force that wage number down. And based upon the jolts yesterday, we still have 10.5 million jobs available for 6 million people unemployed. So that's why the Fed feels like they've got to be tighter for longer. But I think one more quarter in rate hikes, and we should be done, because M2 is actually shrinking year over year. I mean, when you add the rate hikes at this pace, and you add quantitative tightening into the mix, there's an enormous amount of liquidity being sucked out of the system. And I agree, they need to pause. And Bullard sort of suggested that maybe today.
Sounds as though, Anthony, we're still going to have no cuts until 2024 and somewhere a terminal rate between 5 and 5.5. Is that what you think they'll do?
Yeah, I do. I think that I'd love for David to be right. I would love for them to just have one more and then pause. The forecasts that I've read have said that it's going to take us to 5.5%, which then means they're going to have to go another 1 or 1.5% from here, where we are. So the reality is that as much as I'd love for them to pause, I don't think that they're going to. And that unemployment number, until we can get back down to where there's only 1.2 jobs available to every worker, like we were pre-COVID, they're going to keep their foot on the gas. Right now, there's 1.7 million jobs available per worker. That number needs to come down to 1.2 or so, which means the unemployment rate needs to go up, as David noted, about 2 million. That puts us in a 5 or 6%, closer to 6% unemployment rate. That's where we need to be in order for inflation to come down, for the Fed to be comfortable pausing.
All right, well, we'll get that reading on the jobs market tomorrow, but certainly sounds like we have more pain ahead. Anthony Saccaro, David Waddell, thanks so much for joining us here this afternoon. All right, coming up, online retailer Boxed is saying that it's pursuing, quote, strategic alternatives, including a possible sale of the company. Boxed co-founder and CEO Che Wong joins us on the other side of the break. Federal Trade Commission proposing a new rule that would ban non-compete agreements. Now, companies often use non-compete agreements to keep employees from, for example, working for a rival for a certain amount of time or starting a rival business. The FTC arguing that the new proposed rule would increase wages by nearly $300 billion per year and expand career opportunities for about 30 million Americans. Now, according to the FTC, the new proposed rule would make it illegal for an employer to enter into or attempt to enter into a non-compete with a worker, maintain a non-compete with a worker, or represent to a worker under certain circumstances that the worker is subject to a non-compete. Dave, I think the big item here is that the fact that it's likely going to, if in fact this does become a rule, likely going to raise wages, obviously something that the Fed has been working to do the reverse.
Yeah, big picture, it sounds like we're fighting the Fed here. What are they trying to do with the FTC? Well, let me just read what Lena Khan, the head of the FTC, says. Non-competes block workers from freely switching jobs, depriving them of higher wages and better working conditions, depriving businesses of a talent pool they need to build and expand. By ending this practice, the FTC's proposed rule would promote greater dynamism, innovation, and healthy competition, which sounds like it's good for both businesses and employees. Really, this is about reining in large corporations and large businesses. Let's just be honest about it. It is fighting the Fed because they want to bring wages down. This will bring them up by an estimated $300 billion in this country, according to the University of Maryland. And it really fits a pattern by this particular administration, the federal government, to kind of fight back against big corporations. You look at the lawsuit the FTC filed against the Microsoft Activision Blizzard merger. You look at what the DOJ is doing to block the publishing merger of Penguin Random House and Simon & Schuster. This is going to be an interesting push and pull between the Fed and between the FTC/DOJ. Who's going to win? Well, the Fed has greater tools.
The Fed certainly does, but it's interesting when you take a step back and realize how many workers non-competes really impact. It was much higher than I had initially anticipated. There's been studies done saying that it impacts up to 45% of the private workforce here in the U.S., and it's not just the higher income workers that it affects. And it also affects lower wage earners as well. There was a recent study out from the Minneapolis Fed saying that of workers earning $20 an hour or less, these are hourly paid workers, 12% reported having a non-compete contract. So it really affects a broad range of workers here and has massive implications, I think, for the workforce.
Yeah, we've often, I don't know about you, I've signed many a non-compete, but you think about high-powered business owners, not necessarily the case. I mean, hairstylists, for example, often impacted by non-competes because if they leave a salon, they're not able to compete with the salon in their area, which dramatically changes. And really at the bottom of this is job switching, job hoppers, because what we've learned from recent employment data is that the people getting the biggest raises are those job hoppers in this economy. So this will make it easier for them. And again, fighting the Fed a little bit, so it'll be interesting.
We'll see how it all plays out. All right, well, online retail platform Boxed is saying that its board of directors have begun exploring strategic alternatives for the companies, including a possible sale. The company added that it's aiming to announce additional funding within the next 45 days. Joining us now is Boxed co-founder and CEO Che Wang. Che, it's great to see you again. It's been a while, so talk to us just about what happened with Boxed and the road ahead for your company.
Yeah, so it's no secret that we've had quite a turbulent ride in the public market since we've gone public about a year ago. And so you really saw a double whammy between kind of the sentiment around tech companies as well as e-commerce companies really kind of take a dip in not only the US, but the world. During the last several months, as we've kind of spoken about in our previous earnings calls, we've pursued additional financing and we're expecting additional news to be announced in the next 45 days. But as we explore that, we want to make sure we maximize shareholder value. So that includes looking for partners, potential merger opportunities, and potential buyers of the business.
It's good to see it. Theoretically, big picture, seems like an economy that would play into your hands. Inflation has impacted the consumer. Everything at the grocery store is between 10 and 12% more expensive than it was a year ago. So in particular, what went wrong with the business model? It seems to be something that would work, that would play well today.
Yeah, I don't know if I could say anything went wrong with the business model. So I think there's a real disconnect between kind of what we've accomplished as a team and kind of how the stock market has reacted to not only us, but similar companies in e-commerce and technology over the last year. When you look at our last earnings, we reported over an 88% growth in gross margin. Gross profit for our retail business was up over 500 basis points. Our B2B business was up over a combined 50+% through Q3 of last year. So these are all great things, I think, for the business, and I'm really proud that we were able to accomplish because we said we were going to do these things. But at the same time, certainly as you look at the stock chart.
Where's the disconnect with investors?
Yeah, I think it is the macro environment. So, just as you guys have been talking about on, over the last kind of several segments here, really the Fed tightening has kind of dampened the amount of liquidity left in the market and really dampened the sentiment for companies like us. On top of that, I think it's also no secret for anyone that follows us, liquidity has come into focus here. That's why I also think it's really important for us to make that announcement within the next 45 days that we've secured additional financing. Of course, there's no promise that, of course, that we will. And even if an offer is made, it might not be acceptable to us. But at the same time, I think that's one of the other things that has come into focus for our company.
Che, have you gotten any interest? I don't know whether or not you're able to share that with us. And then when it comes to the consumer, you're blaming a lot of the troubles that the company has faced on the macro environment right now. What are you seeing from the consumer just in terms of their willingness to spend and what they're spending on?
Yeah, what's super, so I wish I can comment more about kind of exact folks who have or have not kind of reached out and the interest that we've gotten. I would point folks back to the press release on any additional announcements. If there's substantive updates, we do feel like it's important to let shareholders know, and we'll be sure to do so. On your point about the macro environment and the consumers in this environment, I mean, both of you guys are really hitting the nail on the head. Traditionally in inflationary environments or recessionary environments, what you see is consumers trading up or down. Down in terms of hard discounters, dollar stores. The folks with the wherewithal to stock up because maybe they go through the same drink every single week are going to try to stock up and buy in bulk. And so you're really seeing that. Our average order value, or AOV, is at all-time highs. These are all things that, our net revenue per active customer has grown significantly over the last year. So again, I think what you're seeing is oftentimes what I think before I go to bed at night is where's that disconnect between kind of what we've been doing and where the consumer is spending their money and what our stock performance is. And so that's what the strategic review is all about, as well as the fundraising process.
And you're one of many SPAC mergers that has really turned south in the last year or two. Do you expect Beyond Box kind of a chilling effect in that regard?
I do think so. I think, the SEC kind of got exactly what they wanted to, was to really chill kind of the SPAC market. I can only speak for ourselves in the sense that, we had and continue to have a real business with 9 figures of revenue, a growing gross margin line, a software business that just signed an 8-figure contract. So we hope as we continue along this path as a public company, that folks will disassociate us with kind of how we went public, with the fact that we're a public company doing what we think we can do.
Best of luck to you, Che Wong. Appreciate you being on with us. Thank you.
Thanks very much.
All right, coming up, we'll go live to Vegas to the Consumer Electronics Show. We're talking about one of the biggest issues facing tech, the use of artificial intelligence and how it goes head-to-head with ethics. Stick around. CES time, no shortage of conversation, or should I say chat, about artificial intelligence at CES this year. AI is having a moment. Given the emergence of ChatGPT, and Yahoo Finance's Ali Garfinkel comes to us live from CVS with more on that. Hey, Ali.
Hey, Dave. I am so excited to be here with Alice. Alice, let's start off by just talking about your top issues in AI this year.
Yeah, thank you so much for having me, Ali. So when I think of AI ethics issues, I tend to think of them in three general buckets. So data, evaluation, and governance. So first, data is incredibly important. It's basically the building blocks for any AI model. And especially as we're seeing now a growth in large foundation models, general purpose AI models like ChatGPT has definitely caught a lot of imagination recently, but all of these models are built on tremendous amounts of data. And so thinking carefully about the representativeness of that data. Is it diverse? Is it globally representative? Have we thought carefully about issues of privacy, copyright, all of these different things that go into making ethical data? And then once we have an AI model, how do we evaluate it? How do we make sure that it works well for all consumers and that it reflects our values as a company? And then on the governance side of things, we're really seeing an inflection point with AI ethics from being just something that companies are doing on their own, trying to establish their own policies and standards, to now with the forthcoming EU AI Act, we're seeing policymakers really dive into this space. And this raises a lot of really interesting questions around how do we ensure that we have those governance processes in place to make sure that the AI that is built is compliant with relevant laws and is really creating a better society at the end of the day.
Before we get to, the big questions surrounding AI, I want to, drill in a little bit on generative AI, like ChatGPT, for example, which has made, as you said, has made a lot of headlines. With generative AI overall, what are kind of some of the ethics concerns that you're looking at specifically there?
Yeah, sure. So I think we're at a very interesting moment right now with AI, where it's gone from AI that's often for very technocratic purposes, like risk assessment, things that people don't, or like prediction, things that people don't necessarily see directly or think of as intelligent, to AI that you can interact with and actually ask a question to, or ask to make you an image. And that's really changing the game in terms of what AI can do in terms of interacting with humans. And I think this gives a lot of really promising potential from an AI ethics perspective of AI-human collaborations, but it also brings forward a lot of interesting questions around, how do we ensure that the people who created the training data, for example, are actually appropriately credited or acknowledged? Because we have artists that are creating these building blocks that then become these AI models. And so how do we ensure that this is a process that works well for all of the people in the ecosystem? And then with generative AI like ChatGPT, how do we ensure that this doesn't further contribute to misinformation and a lot of these concerns that we have, given that at the end of the day, AI models, they're kind of like children. They're very smart and, they have some understanding of the world, but it's limited, and they often, can speak authoritatively about things they don't necessarily understand. And so it's very important for AI developers, AI ethicists, as the parents of these AI models, to ensure that they aren't spreading misinformation, they aren't producing biased or offensive content. And so I think this is a really important moment for us in this field.
Yeah, no, and the other thing about it too is there are a lot of different products all the time, coming from Sony in particular, for instance, the new car announcements that came out recently. But I'd love to hear, when you're looking at products, whether it's a car, a PS3, it doesn't matter. How are you thinking about setting up those processes for ethical AI review? Because I imagine it's different for something that's new as opposed to something that's already existed.
Yeah, so this is where a lot of the most important questions are kind of in these like fine-grained governance aspects. And so Sony has been quite a leader in this space. We were one of the first major technology companies to come out with AI ethics guidelines back in 2018. We established our AI ethics committee, which is comprised of senior executive leaders that deliberate in advance of AI usage. And we also have our AI ethics office, which is comprised of AI ethics specialists specialists that work with our business units and our research units on a more bespoke basis to ensure that we're evaluating all these issues like fairness, transparency, safety, robustness, privacy. And it's really, at this point, because AI ethics is still quite a new field, a lot of evaluation is pretty bespoke at the moment, and we're still in the process of developing these best standards across industry. But I think it's really exciting how much Sony has taken a leading role in this, and I think we'll hopefully really be able to set the benchmark for how people think about doing this in the future.
And one last question, Alice. You have a really interesting background. You have a law degree, you have this background in statistics. Built by Girls sent us a question asking what advice you would give to, say, a young woman who's interested in entering the AI field.
Yeah, thank you for that question. I mean, first I would say, please do enter this field. It's extremely, not diverse at the moment, and that's a huge issue when we think about addressing issues like systemic bias in AI. It does start at the point of who is actually in the room when you're talking about developing an AI product. And that set of people needs to be diverse. We need to have a wide variety of perspectives. In terms of, concrete advice, I think it's always good to have a strong technical foundation of what AI is, how it works. But increasingly, especially in the AI ethics field, what we really need is more folks with a strong interdisciplinary background who can understand multiple fields and think about how new technologies might be able to interact with humans and society in ways that might produce intended or unintended consequences. And so I think it's a really exciting space for young women and everyone else, and I really hope that more people enter this field and that we see more of a diverse set of researchers and developers in the future.
Yeah, I'm excited for that. I hope so too. Back to you guys in the studio. Thank you so much.
Thanks, Ali Garfinkel, and of course our thanks to Alice Chiang, a Sony Group Corporation Global Head of AI Ethics and Sony AI Lead Research Scientist. All right, well, there's certainly been a number of very cool gadgets, products that have been unveiled so far at CES, many more to come over the next several days. So it's hard to narrow down a few, but we wanted to highlight some that stuck out to us. So here's a few of them. First up, let's take a look at this. It's something that I think is going to change the game for so many people out there. L'Oreal's eyebrow printer. Now, L'Oreal describes this as the Brow Magic, as a handheld electronic brow makeup applicator. It's similar to microblading, if you're familiar with that, but more temporary, and you can do it at home. So here's how it works. It lets you scan, or you're gonna let it scan your face in an app, and you can adjust how you want your brows to come out, and then you just print them on your face. I don't know how realistic it's going to look, but Dave, a lot of women and men too, spend so much money year after year on their eyebrows, especially if you do microblading. I've never done it, but that costs a fortune.
I spend a lot of time on my brows.
On your brows? No, that's why I said women and men.
Oh, you said men. Okay.
Look,
I fear this. Because are you a Seinfeld fan? I mean, Uncle Leo.
That it's going to miss and just tattoo your eye?
Well, Uncle Leo had some drawn-on eyebrows by Elaine, and everyone thought he was angry because it was off just a little bit, and then people were backing away from him. I joke a little bit about the Seinfeld reference, but are you really willing to trust that? Say you're going out on a big date. Say you have a job interview. Anything that goes wrong in that regard has people looking at you. All right, take camera three.
I think I'm going to want
camera three. Going to be looking at you like that, I would really worry about.
That's why you got the app. It allows for accuracy. You can see how it's going to look on your face before you make any rash decisions. Maybe it messes up a little bit.
But that's a lot.
But it's temporary, so it's not life-changing. Okay. And look, you could do it. You can do what you want to do. I think it's a pretty cool invention.
That would make me very nervous. The gadget I was interested in is a scanner you put in your toilet, and you put it, you got monitors for your health through your urine. The device is by Withings, and it's called the U-Scan. It connects with an app on your iPhone, and you've got a full urine analysis right there in your pocket. That sensor lasts 3 months, and it can track all sorts of things, including your hydration, your vitamin levels. For women, their hormonal levels. So I think this is a really important gadget that is really easy to use and might save you a number of doctor's appointments. You might be able to get that analysis right there in your pocket. Seems really easy, not tremendously expensive. It is $500, But people that are awfully concerned about their health, I think this makes a lot of sense right there on your iPhone.
It makes a lot of sense. Certainly something that I would be interested in. And you talk about the fact I thought it was going to be a lot more than $500. So that's pretty interesting there. And it could detect potential issues relatively early. There was also an automatic self-driving stroller that caught our eye too.
When the baby's not in it.
The baby's not in it, but it was very cool. Costs over $3,000 though, so a pretty penny, but certainly a number of very, very cool gadgets getting rolled out at CES this year. Well, coming up next, with mortgage rates moving higher again, we'll take a look at what's in store for real estate when we come back.
New year, same old problem plaguing the housing market. That's high interest rates. The average 30-year fixed up to 6.48% from 6.42%, according to Freddie Mac. Now, while that's down from the peak north of 7%, still more than double the rates home buyers paid 1 year ago. Zillow senior economist Nicole Bachot here with part of our real estate report brought to you by Intuit TurboTax. Nice to see you, Nicole. So where do you think these mortgage rates settle in, flatten out this year? And will it be enough to really unfreeze the housing market?
While we're seeing inflation coming down a bit, that's going to help put some downward pressure on mortgage rates. But the Fed just yesterday announced that they have no intention of really slowing down rate hikes in general. So we're likely going to see mortgage rates staying, well above those 3% that we saw in 2021, somewhere probably between, the 6.5% is likely where we're going to sit for the rest of this year, without any other, major factors influencing rates.
So, Nicole, what does that mean then for the outlook of the real estate market and what we'll likely see play out over the next 12 months?
So when we're looking at mortgage rates being so far elevated from where they were in 2021, what that really translates to is an affordability challenge for the majority of home buyers and home sellers alike, right? So we have people who are trying to get into housing. Homes are now a lot more expensive than they were pre-pandemic. And you're coupled with these really high rates that have, yes, come down from those 7% peaks, but we're still seeing mortgage affordability taking a big hit in a lot of especially expensive markets across the country. That's going to put a big challenge on buyers to be able to get over that hurdle of qualifying for a mortgage once they're able to find a home that they want to buy.
Yeah, in particular, those first-time home buyers that have really been priced out of markets. You say the Midwest is the most important market as we move forward. Why? And are there specific cities and towns inside that you expect to grow this year?
So when we look at the Midwest, what we see happening right now is, most of those markets we're looking through Ohio, Kansas, Indianapolis, through Illinois. A lot of those markets are typically way more affordable and lower cost than your typical, hot markets that we think of that we saw throughout the pandemic of, Florida and the Sun Belts, throughout Texas. A lot of those markets that were really hot just got way too expensive and unaffordable. Now we see affordability kind of just thriving in these Midwest markets. And that's what's going to draw a lot of buyers to these areas, particularly when we look at remote work and the impact that remote work is going to give to, folks being able to live further away from their workplace. Maybe looking at the Midwest might be an option for a lot of people who want to get into homeownership but are priced out in their own areas. So that's likely where we're going to see a lot of that movement happening. Buyers who live in these areas who are able to afford, given the lower cost, or buyers from elsewhere kind of taking advantage of the lower prices and the relative affordability of the Midwest region.
All right, Nicole, so that's the buyer side of things. Let's talk about the rental market, because that has been a huge story here. The data that you sent over saying that the typical rent in the U.S. still stands just above $2,000, up 8% from the levels that we were at just a year ago. Do you think rents have peaked, and what does that landscape look like in the coming months?
So rent growth has definitely peaked earlier this year. About February, March timeframe is when we really saw the peak of rent price growth, and that started to slow down pretty significantly. But like you said, we're still over 8% growth from last year. That's a big jump when somebody's going to re-sign their lease. When you're, a year up and you're going to re-sign and now you're expected to fork over hundreds of dollars more a month for the exact same unit. That's a big punch to renter budgets that are hit with inflationary pressures from other segments of the economy as well. So this is going to be a big challenge for many renters to kind of face the prices that we've seen. We are seeing rents growth slow down to the point where, a lot of markets are seeing plateauing rent prices, the past couple of months, especially as we're in this kind of slower winter season now. That will be helpful for, renters who are looking to re-sign a lease now, maybe have a little bit more opportunity and options than if you're in the, kind of peak summer season that we typically see. So we're expecting rents to kind of, continue on this cooling path, especially as multifamily housing starts and permits have been up. We're going to see more construction happening in the rental market overall, and that will help to, put less pressure on vacancy rates. That will help to lower prices and give more opportunities for renters to find somewhere to live.
Is there more inventory coming on? That's been a big issue for years.
So yeah, when we're talking about the rental market, we will likely see an increase in especially multifamily buildings, these large apartment buildings, because that's where we're seeing builders kind of shifting their focus to. When we look at the for sale side of the market, we see inventory being the major reason why we're seeing, prices staying as elevated as they are. We just don't have enough homes. We're not seeing construction activity anywhere near the level it should be in order to kind of dig us out of the construction deficit we were in following the Great Recession. We had really good construction numbers in 2021 and the beginning of 2022, but that started to slow way down as prices and especially as interest rates went up and kind of took demand out of the pool for, who is buying new construction homes. We will likely see existing homeowners being more willing to sell their homes throughout 2023, now that we kind of have this stabilization and plateauing of prices and hopefully rates as well, which will just give a little bit more certainty and clarity of what, to expect from the housing market moving forward after coming off of such a tumultuous year that we had in 2022 that kind of pushed a lot of sellers to the point of saying, I don't want to sell if I have a 3% rate and I don't know what prices are going to do. But now that we're in a little bit more of a consistent market, we'll likely see more sellers kind of taking that action throughout 2023, and inventory will increase as a result.
Senior economist from Zillow, Nicole Bichot, good to see you. Thank you. Coming up, rapper Cardi B's latest Twitter rant goes viral. See what she has to say about inflation and grocery prices. Next. Biggest names in tech are in Las Vegas this week for CES. That includes one agency that works to defend the U.S. against cyber threats. Yahoo Finance's Dan Howley got to speak with the CISA director, Jen Easterly. CISA stands
We're one of the newest agencies in the federal government. We've been around now for just over 4 years, and we were built to be America's cyber defense agency. So our mission is to work with all of our stakeholders and shareholders to make sure that we can understand, manage, and reduce risk to the cyber and physical infrastructure that Americans rely on every hour of every day. And when we say things like critical infrastructure, people think it's super technical. But as you know, critical infrastructure is just water and power and transportation and communication and healthcare and education. So, my main message here is not necessarily about cybersecurity. My main message here is about cyber safety, because we live in a world, as you just said, of massive connections where that critical infrastructure that we rely upon is all underpinned by a technology ecosystem that unfortunately has become really unsafe. And so it's incredibly important that us as consumers, that businesses, that all of our partners come together to ensure that we can drive down risk to the nation and make us all safety as consumers.
So what, when you look at the kind of hacks that we've seen in, the recent past, there was the JBS ransomware attack, the obviously meat producer. We had the Colonial Pipeline hack. That was absolutely massive. We were talking about potential fuel shortages. And we continue to see these attacks on smaller municipal governments. During COVID, the peak of COVID, hospitals were a big target. I guess, how do you talk to these kinds of groups and agencies to say, we have to be more preventative, or what kind of advice do you provide to them to ensure that these kinds of hacks they're never going to stop, right? But to minimize them.
Yeah. So look, at the end of the day, we are in an unsustainable position. We cannot have the same sort of attacks on hospitals and school districts that we've been seeing for years. We have to get out of this do loop, and we have to create a sustainable approach to cyber safety. And that's the message that I'm bringing to CES. Because at the end of the day, we've essentially accepted as normal that technology is released to market with dozens or hundreds or thousands of vulnerabilities and defects and flaws. We wouldn't accept that in any other critical business and society. We've accepted the fact that cyber safety is my job and your job and the job of my mom and my kid, but we've put the burden on consumers, not on the companies who are best equipped to be able to do something about it. And that's a real problem. And so the message is sustainable cybersecurity is 3 key things, Dan. It's about technology companies creating products and software that is secure by design and secure by default. Secure by design, what do I mean? I mean that they're creating products with a minimum number of vulnerabilities and flaws, and by default they have those safety features baked in. It's like when you buy a car, you wouldn't buy a car without airbags and seat belts and crumple zones and anti-lock brakes. We as consumers have to demand that from our technology. So secure by design is all about cyber safety. Second, corporate cyber responsibility. And that's really about CEOs and board members actually embracing cyber risk as something that's a matter of good governance. They have to work to drive down cyber risk. They have to own it. It can't be that the IT people or the chief information security officer is responsible for cyber risk. CEOs have to embrace CCR, corporate cyber responsibilities, just as they've embraced corporate social responsibility as a matter of good corporate citizenship, because cyber is a social good. It's about societal resilience. And my last message is we need to fundamentally change the relationship between government and industry, which over the past few decades, we've been talking about public-private partnerships. It's become really hackneyed because the relationship is episodic, the relationship is unidirectional, and there's not a lot of trust there. And so over the past year and a half, we've really looked to try and transform that relationship and make a paradigm shift in something where there's a default to share information, where the government is much more transparent and responsive and value added, and where we're seeing this as shared responsibilities. This isn't a problem the government can fix. It isn't all on the back of the technology companies. It isn't all in the back of citizens. We all have to look at this together to ensure that we are a cyber safe world.
So it's a kind of a grouping thing. I guess, just as far as getting more people into cybersecurity, I believe it was earlier this year you had mentioned that you wanted to have CIS's workforce be about 50% women by 2025, you were hoping, I believe. How do you get more women, young girls, gender nonconforming people into cybersecurity? What's the kind of way to push them towards that or engage them with that?
Yeah, so first of all, not just CISA, because we're well on our way to 50%.
Oh, wow, okay.
But all of the cybersecurity industry, I think, has to be 50% women or non-binary people by the year 2030. Now, that's aspirational, but I think if it's a goal that we can all get behind, we can actually make it happen. How do we do it? Well, first of all, we have to start with the youngest among us. We have to ensure that cybersecurity is integrated into the curriculum from kindergarten all the way up to 12th grade, so that earlier on we're getting people who wouldn't think about tech because it sounds scary and complicated, more interested in technology and cybersecurity, again, from the youngest of ages. It also helps our kids be more cyber safe, because even as they play on all their devices, they're thinking about, okay, what do I need to do to ensure that I'm safe from all of the bad actors that are out there? So that's hugely important. The other thing that we're doing is working with the Girl Scouts and Girls Who Code and the Cyber Warrior Foundation and NPower, giving them grants so that we can get out there and expose more young women and girls to the fact that cybersecurity is a fantastic career. It's why I spend a lot of time trying to inspire and inform young women about how great it is to be in cybersecurity as a career. So it's something that we all have to take responsibility for. Be aspirational, believe in the transformation of the cybersecurity workforce, and I think we can get there. It's a tough goal because I think we're about 24% right now, but you got to aim high.
All right, Director Easley, thank you so much for joining us. We really appreciate it.
My pleasure. Thanks so much, Dan.
Terrific stuff from both. All right, kudos. Sky-high prices, meanwhile, being felt across the United States, and no one is immune, not even the rich and famous. Rapper Cardi B has been tweeting about high grocery prices on January 3rd, writing, quote, "You might as well eat outside." Some of her followers questioning why she's speaking out on it as a rich celeb. Well, Cardi B pushing back, posting this video.
I went to the supermarket and I'm seeing that everything tripled up. That like lettuce was like $2 a couple of months ago and now it's like $7. Of course I'm gonna say something. Because if I think shit is crazy, I can only imagine what middle class people or people in the hood is motherfucking thinking. So yes, I'm going to say something. And I have a big platform, so I do want anybody that's responsible of these prices to put the down. They're gonna see my shit, they might put it down.
Wow, the censors were hard at work there. Rich, but not rich enough for a ring light. We just need to see a little bit. Cardi B's song, Up, and are you ready for this? It includes the lyrics, if it's up, then it's up, then it's up, then it's stuck. Now, if it's stuck, we got a major problem. That's where the Fed comes in. They fear
I like what you did
Cardi
there.
B's lyrics that it's stuck, and they're trying to loosen it. I think, look, she obviously
I didn't pin you as one to be familiar with Cardi B lyrics.
I
You
Googled
surprise
it.
me
I
every
am
day.
not a Cardi B
Okay.
guy, full disclosure. But look, it's just oversimplifying a very complicated problem. I'd love her to sing a song about it, to educate young people on what's happening with inflation, but someone ought to sit down with her and explain that you can't just tell one person to bring down the prices. It had to maybe be the most oversimplification of a complicated issue I've ever heard.
Yeah, certainly is a very complicated issue. Weather, supply chain, geopolitical unrest, all playing into the price that we're paying for food today. And when you take a look at these prices, though, it's no surprise that we certainly are seeing outrage, not only from some people, middle class people, obviously people that are living paycheck to paycheck, but even the rich are getting very, very frustrated. I love it that she took up this issue. She has over 27 million followers on Twitter. It shows that she really sees the issues that are going on, what's affecting her followers, what's affecting her fans.
Them.
She doesn't understand, but I think she's in tune with what so many people are struggling with on a day-to-day basis.
Okay,
and that's
Mark
what I like
Zandi
about
and
it.
Cardi B. That's what we need, because he can help.
Yeah. Well,
Zandy, Cardi.
he can teach her a few things. We're going to have him on the show next week, so maybe we can get him to weigh in on all this.
Magic.
All right. Well, coming up, the do's and don'ts of airplane etiquette. We'll break down travelers' biggest stressors when we come back. All right, we got a couple stocks for you in after hours trading. Let's take a look at WWE, and you're looking at gains of just about 11%. The move to the upside in the midst of Vince McMahon staging a comeback. You heard that right. The ousted former CEO that was ousted over the summer amid sexual misconduct allegations could be back at the company. Now McMahon is the controlling shareholder, elected himself as the executive chair. And here are the details of this. McMahon saying that he needs to be a part of and is gearing up for negotiations over media rights and strategic alternatives. There are talks of a potential sale. You're looking at WWE on an intraday basis was up 2%, but that after hours move is what we're really focusing on with gains of just over 10%. And let's take a look at Costco moving to the upside here, up nearly 3%. This is on strong results for its holiday sales. Those December numbers coming in better than what the street was looking for. Total December sales coming in at 5.5%. U.S. sales ex gas and currency coming in at up 7.3%. The estimate, Dave, out there was for a 5% increase. It is important to point out e-commerce sales, though, actually dipped during the month. But overall, sales are strong for the company, and that's why we're seeing gains of just about 3%.
Seen that a bit with e-commerce. WWE is going to be one to watch.
Certainly, yes.
I'm watching Comcast, I'm watching Endeavor, and then Apple and Amazon, who has enough cash and needs that content. All right, questions around plane etiquette are driving the internet. The first involves a hack when couples use booking seats. The couple will book the aisle and window in hopes the middle seat is empty. I should note I've done this for years and years. Usually someone comes to sit in the middle seat. The couple will offer to swap one of theirs for the middle so the solo traveler doesn't have to sit between the two. Some don't like this particular move, Shonda. I find that it used to work pre-COVID because that empty stayed middle. But since loads have been around 90% on all the airlines, I'm often finding someone sitting in the middle. And I'll just be honest, my wife and I are like, nope, I'm good. You sit in the middle. We've been married 20 years.
You're not gonna pressure the person. I know. Well, this all came to light when someone wasn't willing to give up their middle seat. I want to know who that person is, the diehard who loved their middle seat, or if he was just trying to take a stand here. But I do it all the time. We used to do it all the time. And I actually do agree with you. Ever since COVID, flights have been more and more crowded, especially if you're on one of those crowded routes that you don't typically have many empty seats left. So it's a little bit, you're taking more of a risk, I should say, if you still use this strategy. I've used it many times and it's worked many times. I didn't know so many people were using it though.
Yeah, etiquette has really gone south, and what you're seeing is people, they just assume that a fellow passenger will be willing to trade with them in whatever the circumstance will be. Some say, hey, they want to sit on the window and they're asking someone to switch.
Yeah.
So you should not assume that someone wants to make that switch, even if it's for your kids. People pay now for each individual seat on most cases.
Yeah.
And so it seems like people have just gotten a little bit out of hand.
And then there's the issue of whether or not babies should be in first class, because that triggered an outroar. Apparently, there was a Washington Post article saying that a lot of people are taking issue with parents bringing their children into first class. I have one message for everyone out there who is hating. If you are paying for that seat and you want to bring your baby or you want to bring your child into first class, who is anyone else to say no or complain?
If you have a crying baby that you know travels poorly, stay out of first class.
How do you know if your baby travels poorly? And I know you don't deep down.
I can't afford first class.
All right, well, that'll do it for us today on Yahoo Finance Live. Be sure to come back tomorrow, 3 p.m. Eastern Time. Have a wonderful night.
You know.